Rajashekar Iyer, Masterclass with Super Investors. So Rajashekar is a chartered accountant. He has a pretty interesting story. We have a lot to learn from him. So what are the key insights from Rajashekar Iyer? Born in Tamil Nadu, moved with his parents to Ahmedabad, became a chartered accountant, went to Mumbai, and did a great job in Mumbai, and then realized that he could make 6 times more money if he worked in Bahrain. So he moved there and started buying IPOs. So as an NRI, he said that he had to pay no taxes in the Bahrain government and he could save 50%. So he had a cash machine with his job that he did as a chartered accountant. Saved up a lot, and then in 5 years came back to Mumbai and then realized, hey, he didn't want to do a job anymore. He wanted to do something that was interesting, that he felt contented with. So he started reading a lot of journals because he was trying to figure out, like, these IPO shares that he bought in India, which ones to keep, which ones to not keep. And so he started, with his chartered accountant background, he was able to read a lot of this analysis. Then he critiqued the journal and found out that they could do a much better job hiring journalists. So he wrote to the editor. He got back a role saying, hey, why don't you be the journalist? So he started becoming a journalist. And he wrote and eventually became the editor. Then had a pretty successful run. Then started doing research to find out more about valuation, equity, and started his own PMS fund over time. He started layering his skills. He started reading lots of financial statements, which his BCom CA background helped him with. Went into a lot of annual letters of the company to justify himself. He was looking for 3 things. He was looking if the management is optimistic. He was looking for ratio analysis on the balance sheet. He was looking to find out if there's growth in earnings. And finally, if the industry is facing headwinds or tailwinds. So that was how he started. And then the articles that he wrote initially got a big boost, and the magazine did quite well because it was the rise of the Indian stock market, the biggest bull run, 1992. The market went up 11 times in 4 years. So he did a lot of writing initially. So didn't make money except for his IPO shares that he had, I believe. And he came to a first realization that stock gain is due to 2 reasons. It's either the earnings growth or it's the PE re-rating. So he realized that very quickly. And even though trying really hard to figure out what new skill to add, he did learn technical analysis, but he just didn't, feel comfortable with it. And he kept going to the fundamental analysis. He tried learning Elliott wave, no luck. After that, he stopped it. It's like, hey, I'm going to go on the valuation route to understand more deeper. And so he was recommended security analysis by Benjamin Graham and Dodd, and then Graham's Intelligent Investor. So he then understood what price to buy and what price to sell using that book. And he also learned how to figure out, by a lot of his reading, when to predict that this market is going to be the start of a bear market or start of a bull market, because he realized that he sold very quickly in a lot of instances. He realized that he held on to shares during the peak bull runs and then they crashed. So he kept layering his understanding. He then realized that, hey, macro has a huge role to play because there's liquidity squeeze, money flows at a pretty big margin, right? Because not all money that's invested in stock is from the household domestic savings. Lots of FII money comes in that depends on the macro conditions, and central banks that not only try to control inflation but also look at growth due to job creation. So he kept learning, he kept adding his skills, and slowly he built this whole mental model. So started reading balance sheets because he had the background, then understood how to understand how to parse out the business model through annual letters, understood that there's impact on interest rate on money flow, so macro understanding, understood and built awareness on market cycles to time the bear and the bull markets, read lots of books, found out how to do risk management, when to sell, how to build a position, how to trail stop losses, how much to buy, portfolio sizing. So look at that. He's added one skill at a time and kept getting better. And he shared a really good tip, which was averaging up on really good shares, which I felt was pretty amazing, because if you add to that the trailing stop loss, which just keeps going up, then you can actually build up a pretty sizable portfolio. And the stop loss could be something like 2 times the last 20 weeks range of up and down, right? So if you see the up and down close price, you can have a stop loss that's 2 times the range of peak and bottom change. So that was really interesting, how to set a stop loss and actually still build up a pretty sizable position. And one other major learning, which I have been guilty of, which is to never average down. If you see a huge correction in a stock, like most recently Alibaba, right? You don't want to average down because it can keep going down. It's like a falling knife. You only want to average up. So that was a really good one. And using technical analysis as just one input, because there's lots of price action. You can find out what the other participants in the markets are doing. And he really likes to instill this point, which is to ride the bull, meaning don't cut profit short. Just use the trailing stop loss and keep going up, ride it up. And when it drops below a certain threshold, you sell it. So also avoid industry headwinds companies, because it's very important. You can't really do anything about it. Management, how do you deal with analyzing if the management is good, right? And so management capital efficiency is the key, right? So are they allocating capital efficiently? And are they using the capital that's allocated not only efficiently, but in the right areas? So meaning, are they strategic in capital allocation? And once they've allocated the capital in the right direction, are they executing? Because what goes from, in the income statement, you get the gross margin. And between gross margin and net profits, that's the efficiency game. So if there is slacking happening, the working capital is increasing, inventory is going up, accounts receivables going up, or payable period is going down. So lots of things that the management can do. So analyzing management's capability and efficiency is important. The company has a moat, or the product is good if it has high gross margin. That was a really good learning too. And he looks for some back of the envelope situations like, hey, can the company 10x without diluting the equity? Meaning, does it have enough cash flows to actually keep investing, reinvesting, and growing? So that's a really good indicator. Read widely. He reads like 2 books a week. That was huge. And he says you just need to invest 20 good companies in your whole lifetime, which Warren Buffett says, and he quoted. And type A errors, wherein you commit a mistake when you shouldn't, is expensive in stock market. Type B, when you should have invested but you didn't, is okay. So he shared that, which was a really good way of summarizing errors. And the other big takeaway was introspection, meaning when you make certain trade decisions, first write down, why did you make certain decision? What was your investment thesis? And then learn from your mistakes, meaning you don't make the same mistake again and again. So writing down your hypothesis, the reason why you're buying, the reason why you're selling, if you made a loss, build that analytical thinking and do your homework. So that when you ask questions, let's say with the management, you actually ask relevant questions. I actually learned from this one chapter significantly more than what I did in the previous chapters. So great job, Rajashekar. So he also shared like how he builds his portfolio. So he has 5 stocks, each 15%, total 60%. So 60%, majority of his portfolio is in 5 stocks at any given point. Then he has another 5 with 3% each, approximately, which another 15%. He has 10 stocks, 1.5% each, where he's building up position or he's reducing position, 15% each. So that's his 20 stock portfolio. And he really believes in valuing the earnings that are upcoming or current much more than the overall valuation of the company or even the turnaround potential. He just thinks at that decreasing order of value. He doesn't like DCF because he thinks it's marrying projections, which is bad data, with reality, which is current data or current numbers. So he actually uses a back of the envelope calculation. He shared how 25 times profit, or if you build from the profit, how much interest rate can currently give, what's an annuity for that, what's a perpetuity for that, this is perpetuity, and add to that GDP growth, and you can find out like what the valuation is for generating that much delta. So if you add the interest rate, the delta of GDP, and then find out what the perpetuity is for the profits that the company makes, that'll explain most of the valuation, and then add to the delta of what the market cap is and reduce from that this perpetuity, you will get whatever the premium the company is getting, or because the market feels they'll have efficiency coming up. So comparing the benchmark of the industry as to how the industry is doing overall will help to relatively find out if the company is doing really well. And he says avoid leverage. He only uses it in exceptional circumstances, and the reason is simple. He says you could be wiped out before you are proven to be right, because you don't know how exuberant the market could be. It could be going up until you become insolvent, and it could be going down in the same price, right? So you don't know when the price will converge. And PE of an index is not as useful because the composition of the index changes was good. And then human emotions are the cause for undervaluation and overvaluation. That happens all the time. So he doesn't believe in the efficient market hypothesis, which is a good thing, right? Behavioral finance. And this was the other key point, which I really liked. He said, everyone has different perspectives. Build the self-confidence to think for yourself. That was amazing, right? Because you know what your temperament is, you know what kind of investment you like, and not everyone will give you the same advice. So what kind of companies you want to invest in? Is it consistently performing? Is it like 3x returns in a year and then 2 years so no return? You have to find out what works for you and follow your thinking, which was good. And finally, this is the last slide. He's shared so many books. So I actually categorized all of the books. He shared books on market trends, risk management, valuation, and trading. So there's like more than 12 books here that he shared, which tells us how to actually predict, bull markets and bear market cycles, like market trends. He shared 4 books for that. Risk management, how to handle the drawdowns, which he thinks is very important. Valuation, how to value a company. And trading, right? And he shared really good books, and he shared context around each of these books. So very well read investor. Lot of learning from this chapter. The chapter was like 60 pages long, but a lot of interesting learning. So there you go, Rajashekar Iyer. Thanks.